How much money do you actually need to invest to become wealthy? Most people have absolutely no idea. They know they should invest, they know they should save, they know retirement is important, but when you ask them a simple question, how much are you trying to build? The answer is usually vague. A lot. Enough. Whatever I can. And that's the problem, because you can't create a roadmap without a destination. Imagine trying to drive across the country without knowing where you're going. How would you know which roads to take? How would you know if you're making progress? How would you know when you've arrived? The same is true with investing. If you don't know your target, you'll never know whether your current strategy is enough. In this episode, we're going to change that. You'll learn how to work backward from your goals, calculate your investment targets, identify investment gaps, and create a clear roadmap toward financial freedom. Because becoming wealthy isn't magic, it's math. And once you understand the numbers, everything becomes much clearer. Most people approach investing backwards. They start by asking, what stock should I buy? What's the best ETF? What's the hottest investment right now? But those aren't the first questions you should be asking. The first question is, what am I trying to achieve? Because investing isn't about collecting assets. It's about funding future goals. And different goals require different amounts of money. Someone saving for a home deposit has a different target than someone pursuing financial independence. Someone planning to retire at 65 has a different target than someone hoping to retire at 50. That's why every investment plan should begin with the destination, not the investment. Start with the end in mind. Let's imagine you have a goal. Perhaps you want $1 million invested by retirement. Or maybe your goal is $500,000 or $2 million. The exact number isn't important right now. What's important is that you define one. Because the moment you define a target, something powerful happens. You transform a dream into a measurable objective. And measurable objectives can be planned. This is where many people experience their first breakthrough. They stop thinking about wealth emotionally and start thinking about it mathematically. Once that shift happens, investing becomes far less intimidating. One of the most useful skills in personal finance is reverse engineering. Instead of asking, how much will I have someday? Ask, how much do I need and what must happen to get there? Let's look at a simple example. Suppose your goal is to accumulate $1 million over the next 30 years. Now you have a destination. The next step is estimating growth. Historically, diversified investments have generated positive long-term returns, though future performance is never guaranteed. The purpose isn't predicting the future perfectly. The purpose is creating a reasonable plan. Using growth assumptions, you can estimate how much you'll need to invest regularly to reach your target. Suddenly, the goal becomes tangible. Instead of focusing on a giant number, you're focusing on monthly actions. And monthly actions are manageable. Why big goals feel impossible? Many people become overwhelmed by large financial goals. $1 million sounds enormous. $2 million sounds even bigger. And because the number feels intimidating, they never start. But here's what most people fail to realize. Wealth is rarely built through one giant action. It's built through thousands of small actions repeated consistently. Every contribution matters. Every investment matters. Every year matters. And over time, those small actions compound into something extraordinary. The wealthy aren't necessarily people who made one brilliant decision. They're often people who made good decisions repeatedly over long periods of time. Understanding the investment gap. Now let's talk about one of the most valuable concepts in financial planning. The investment gap. An investment gap is simply the difference between where you're headed and where you want to go. For example, suppose your current investments and savings are projected to reach $500,000 by retirement, but your goal requires $1 million. You have a $500,000 gap. That gap isn't bad news. It's information, and information gives you options. You can increase contributions, extend your timeline, reduce your target, increase income, delay retirement, or make other adjustments. The key is knowing the gap exists, because once you know the gap, you can start closing it. Many people obsess over investment returns, but contributions often matter more than they realize. especially in the early years. Think about it. You can only control a few things in investing. You can't control markets, you can't control interest rates, you can't control economic cycles, but you can control how much you invest, you can control consistency, you can control discipline, and those factors have an enormous impact over time. In fact, many successful investors built substantial wealth not because they picked extraordinary investments, but because they invested consistently through every market condition. Month after month, year after year, regardless of headlines, regardless of fear, regardless of uncertainty. One of the reasons people underestimate investing is because compound growth feels slow in the beginning. At first, progress appears insignificant. Your portfolio grows a little, then a little more, then a little more. It doesn't feel exciting. But compounding works like a snowball rolling downhill. The longer it rolls, the larger it becomes. Eventually, growth starts accelerating. And that's when many people realize the true power of investing. Unfortunately, many quit before reaching that stage. They become impatient, they expect immediate results, and they abandon the process. Successful investors understand something different. The early years are not about getting rich, they're about building momentum. Your future self is counting on you. Here's something worth thinking about. Every dollar you invest today is working for a future version of yourself. A version that may no longer want to work full-time. A version that may want more flexibility, more freedom, more choices. The investments you make today create opportunities for that future person. And the longer you delay, the harder that job becomes. That's why investing isn't just about numbers. It's about options. It's about creating a future where money provides flexibility instead of stress. Why time matters more than perfection. Many people spend years trying to build the perfect investment plan. They research endlessly, analyze endlessly, compare endlessly, and never actually start. But investing doesn't require perfection. It requires participation. The best plan executed consistently will usually outperform the perfect plan that never gets implemented. Remember, time in the market generally matters more than trying to perfectly time the market. Every year spent waiting is a year compound growth cannot work for you, and those lost years can never be recovered. One of the best ways to stay motivated is to regularly revisit your goals. Don't just look at your account balance. Look at what the money represents. The house, the retirement, the financial independence, the opportunities, the freedom. Money is only a tool. The goal is what gives the tool meaning. And when your goals remain visible, consistency becomes easier because every contribution feels connected to something important. The wealth building formula. If we simplify wealth building as much as possible, the formula looks something like this. Set a target, determine a timeline, calculate the gap, invest consistently, allow time to compound, repeat. That's it. Not flashy, not complicated, not exciting, but incredibly effective. Most wealth is built through disciplined repetition, not dramatic breakthroughs. Common mistakes to avoid. Before we wrap up, let's quickly cover a few common mistakes. First, investing without a goal. Second, focusing entirely on returns while ignoring contributions. Third, constantly changing strategies. Fourth, becoming discouraged by short-term fluctuations. And fifth, underestimating the power of time. Avoid these mistakes and you'll already be ahead of most investors because successful investing is often less about intelligence and more about consistency. Wealth isn't created by guessing, it's created by planning. The moment you define a target, calculate the gap, and begin investing consistently, you move from wishing to building. And that's where real financial progress begins. Remember, start with the destination, work backward, focus on contributions, trust the process, and give compound growth the time it needs to work. Because becoming wealthy isn't about finding the perfect investment. It's about creating a plan and sticking with it long enough for the math to work in your favor. In the next episode, we're going to build on this foundation and discuss one of the most important investing decisions you'll ever make: how to structure your portfolio. We'll cover stocks, bonds, diversification, risk tolerance, and how to create an investment strategy that matches your goals and stage of life. I'll see you in the next episode.